and thank you for joining us for today's market briefing. Today, we will discuss some current market drivers and how they've impacted investment returns. Let's start by highlighting a few key recent events. The resurgence of COVID due to the Delta variant has slowed the economic recovery and created some choppiness in growth across industries. Fortunately, it appears that the recent spike may be fading, and more importantly, that the virus wave was less fatal than the experience last winter. Outside of the US, the Delta wave has had a similar pattern with a strong spike and relatively faster fade. A key factor in the pace and strength of global economic recoveries has been the ability and utilization of COVID vaccines. As of September 22nd, nearly 56% of the total US population is fully vaccinated. The US vaccination rate has been gradually increasing, while many other countries have had different experiences depending on availability and infection rates. Because of this, it is likely that global economic recovery will continue to be choppy. Worldwide, roughly 33% of the population is fully vaccinated, with a little over 6 billion doses already given. Continuing with our focus outside of the US, there's also been many headlines surrounding China and the Evergrande crisis. Most of the concerns seem to center on the strength of China's financial system, especially following decades of rapid economic expansion. While most investors seem to perceive the Evergrande situation as an isolated event, there's worry that it could escalate into a broader downturn of China's real estate market and subsequently create a strong headwind for longer-term economic growth in the country. Let's focus back on the US. While nothing has been resolved yet, there recently has been a lot of focus surrounding fiscal policy and the so-called federal debt ceiling. Markets have been paying close attention, especially when considering the record level of federal net debt as forecasted in the bottom right chart. As government spending continues to far exceed its income, annual deficits will continue to compound the accumulated debt levels. So how have these recent events affected the financial markets? Interest rates remain low relative to history and have been trending higher more recently, despite some volatility. Most investors view this trend in yields as a function of rising economic growth expectations along with potentially higher levels of inflation. Inflation expectations clearly have picked up since the pandemic took hold. With COVID not going away so smoothly, investors now seem to expect this inflation spike may last longer than originally expected. As of the end of August, the 5-year Treasury implied inflation break-even rate was about 2.6%. Turning to the stock markets, we see that recent events have slowed the gains in higher-risk stocks, such as emerging markets, while safer stocks, such as U.S. large-cap stocks, have continued to rise fairly unabated. Looking within the broad U.S. stock market, these recent events have shifted the performance of value and growth stocks. Since the announcement of the Pfizer vaccine last year in November, value has outperformed growth. However, more recently with the news of the Delta variant, that dynamic shifted and growth stocks have been outperforming value stocks. If the economic recovery continues to be choppy, market conditions may continue to favor growth stocks. Overall, stock market gains have been well above average this year, and with limited volatility, seen here with only a 4% drawdown year to date, in comparison to last year's drawdown of 34%. While volatility has been relatively low so far, it seems likely to pick up in the near term. As always, we continue to recommend maintaining diversified portfolios of investments that have the potential to perform well in broad range of market outcomes. The uncertainty around global economic events could increase volatility in the coming months, and corrections in the equity markets are possible. From all of us here at RMB, thanks for tuning in, and we hope you're able to join us for our next market briefing.